All right, sorry, I forgot that. I needed to record at the beginning. So I'm going to start presenting. And like I said, if anybody's trying to get into the Zoom meeting, please let me know so I can get out of full screen mode and I can let them in. So. All right. Is everybody able to see my screen? Okay. Okay. So investing. So we are a club, but we call ourselves the Denison Investment Group because in the world of finance and investments, the word group sounds a lot more professional than organization or team. So if you are applying for finance positions or looking at just a general investment firm and they have different groups, a group is another name for a team. It just sounds more professional. So the agenda I want to cover today is starting off with what is investing in the first place. I have experience investing, but I've also had 2 internships, acting president of an investment group. I invest in my own time. I make and lose money on my own time and off my own money. So I do have a lot of experience, but I understand everybody here might not have as much experience. So if you need help understanding a concept, speak up, or we can also save questions for the end. So I'm going to start off with what is investing. I'm going to go over some common misconceptions about investing. Then I'll be going over stocks and bonds, what each mean, what's the difference between the two. I'll be going over what a portfolio is. I'll then be showing you guys the group's portfolio that we manage through our broker-dealer. Then I'll be going over what a broker-dealer is. Then I will cover up with some of the risks that are associated with investing in the first place. And then I will open up for general questions. So looking forward to it. So what is investing? So I understand that you guys had a session over budgeting. Did you guys also cover some of the fundamentals of a savings account and how that works with a bank?
No.
Okay. I'll cover that then. So when you go to a bank and you open up a checking account or savings account and you put money in with that bank, you are putting in deposits. What that bank does is they use those deposits as a pool of cash. And what they do is they take those deposits and they invest it. It could be through small business loans, mortgage loans, other securities. They invest themselves. They have corporate clients, they have retail investors, they have institutional investors that they deal with. So the money you put into your checking account or your savings account, it's yours. You have a right to it, but it's not the same money that you put in. So let's say I put in $1,000 into a savings account. Let's say I then withdraw $500. That $500 is somebody else's money. Because how a bank works is they generate revenue off the interest from their investments that they make from the money that you put in with them. In exchange for that, the bank does give you interest back. So, for example, I have a savings account that's a little bit above $2,500, and last quarter I got paid an interest payment of 11 cents. Very small, but that 11 cents is for me holding that cash with that bank. That's how a savings account works. Investing money is similar to that. So what you're doing is you are lending your money, your capital, to an entity with expectations of gaining greater returns within the future. So, and oftentimes any sort of financial product that deals with investments or securities, we call a financial vehicle or investment vehicle. And we can get into that later. So some common return forms on your money that you put in can be in the form of capital appreciation, dividend income, and coupons from fixed income. And we will be covering these later in the presentation, but a short rundown. Capital appreciation is the money you make purely off the profit when you sell a financial asset for more than what you bought it at. So let's say you bought 1 share of Apple for $100. Let's say in a year, that share of Apple goes from $100 to $150 and you sell it. That difference of $50 is the capital appreciation that you gain from that 1 share of Apple. Dividend income is when a company pays out dividends to their shareholders. So it's usually every quarter, every 3 months of a fiscal year, or more commonly known as a calendar year in a lot of companies' cases. A company will pay you for just holding shares of that company, because what you're doing is you're lending your money out in exchange for a certain amount of shares that gives you a right of ownership to a very, very small percentage of that company. And when a company generates a lot of revenue, what they then do is they take a portion of that and they divvy it up and they send it out to their shareholders. So think of a company's revenue as a pie. You as the investor are going to get a couple crumbs of that pie, but you still get a part of that pie. A lot of those parts of the pie goes to financial operations, operating expenses. If they incur any losses, it's used to cover maybe insurance. If a company goes down and they start making less and less revenue, your dividends will become less and less and less because they won't have as much money. And coupons from fixed income are related to bonds. I actually have an entire slide dedicated to what exactly a bond is and the fundamental mathematics behind a bond. And I did say, so investing money is lending your money to an entity with the expectations of gaining greater returns in the future. So what are some of these entities that you can invest in? Publicly traded companies are one of the most common forms of entities. So Microsoft, Walmart, General Motors, General Electric, Apple, Tesla. These are all publicly traded companies they have millions, if not billions, of their shares bought and sold periodically. And you can also invest in governments. So you can invest in the US government by buying US government bonds, but you can also invest in foreign governments by buying bonds from other countries. A lot of bonds from Europe are pretty popular. So here are going to be some of the fundamental terminology terms that I sort of want to impose on all of you. So a market is a platform for buyers and sellers of financial assets and securities. So it's just a general term for a place where you can buy and sell shares of Apple or bonds from the US government. And on the other end, there's a seller if you're buying, and then if you're selling, there's a buyer on the other end. And whenever I say securities, I just mean investment products. So stocks, bonds, commodities, currencies, these are all forms of securities. So when I say securities, think of products that can help you secure your money, secure your wealth, and grow it. Knock on wood. A stock is equity in a company, a portion of ownership. Debt instruments are also called bonds or fixed income. Debt issued to be paid back with interest to the investors that hold the bond itself. So think of going to a bank and you take out a loan. That bank is going to give you money, but you're going to have to pay that back in portions with interest attached. That interest is going to be the profit that a bank makes off of you taking out debt upon yourself. Companies and governments do the same exact thing, but it's reversed. They are taking out debt upon themselves by issuing bonds. So when the US government issues a 30-year-long bond from their Treasury Department, you are going to be giving them your money. And then they're going to give you a bond, and then they're going to pay you interest in the form of a coupon every 6 months, every year. And at the end of that 30 years, you're going to get that money back. So let's say, we'll get into this more in depth with my sample, but if you give the US government $1,000 for a bond, and let's say that's the term at the time of the bond is 10 years. At the end of 10 years, you're going to get that bond back, but they're also going to give you periodic payments for allowing them to sell you that bond, and you give them money. And this sort of flows into an index. So an index is an aggregate of a certain amount or a type of security. So different groupings of companies form together to form an index. So An example would be the S&P 500. I don't know if you've heard of it before, but the S&P 500 is an aggregate composite of all of the first 500 largest companies in the U.S. are what makes up the S&P 500. So if the S&P 500 is up a certain percentage on the day, a lot of people refer to it as, the markets are up, the economy is up for the day. Because if those companies are doing well, those companies are seen as a representative of how the American economy is doing. But disclosure, how the stock market behaves is not an indication of how well the economy is doing. And when somebody refers to a fund is just a sum of capital that's allocated to specific securities to serve an objective. Most of the time, it's just to make you money over time. So, common misconceptions when it comes to investing. So, at the bottom left hand of the screen, I have a snapshot of my brokerage platform, E-Trade. This is a trend line of the S&P 500. So, what I want to sort of put across you guys is that market timing can be accomplished by buying the dip, but market timing is never a good strategy when you're investing. So generally you want to buy low and sell high, but you can never tell the future. Nobody can time travel, so it's impossible to say what the price of a company is going to be like in a week, in a month, in a day, in an hour even. So during the COVID pandemic, the general economy really took a toll, especially in the middle markets and small business markets. But the S&P 500 index in March went from almost $3,400 per price point in that index. It took a nosedive by over 1,000 within the course of half a month, which is huge. And again, index is just an aggregate composite of various companies. So those 500 companies together took an average nosedive of $1,000 per share, split up between those 500 companies. So it could go up, it could go down. If you buy the dip, which is like the lowest point, you could buy at the very beginning of March thinking it's going to end there, but then it continues to go down and down and down. And then you freak out and you sell it at the very lowest point, and then you lose out on a portion of your money invested. Some people buy at the highest point, and then the company or the index goes immediately down the toilet. So I just want to say this. So the conception that you can time the market and you can make money off of buying the dip and selling high all the time is false. You can never do that. You can get lucky, certainly, but it's never a good strategy. You should always take classes. You should always do independent research. You should always do research on the company itself using various third-party platforms before you decide, what do I want to do with my money? So some more misconceptions is that, if you make a gain on your securities, that they're going to be all yours. That is true up to a certain point. I believe in the state of Ohio, any brokerage account that is underneath $12,000 in value, they will not tax. But anything over, you do get taxed. So, for somebody who has a $1 million portfolio, if they make $100,000 within 1 year off of their securities and their trading, they have to disclose that with the IRS, and they have to pay tax on that. So depending on when and where you sell it, determines the tax rate. So a short-term capital gain is a profit made off of a stock that you held for less than a year. A long-term capital gain is a profit that you made off of the stock that you held for more than 1 year. So example would be if I bought $1,000 worth of a shipping company and I sold them within 5 months and I gained, let's say, another $1,000. I'll have to pay a lot more tax on that $1,000 than I would have if I sold it after I held it for 1 year. Short-term capital gains are always going to cost you more tax-wise than long-term. So that's always important to remember. And there's always the age-old saying of, stocks always go up. That sometimes is true. Sometimes it's not true. Companies can go bankrupt. In that case, the stock is going to take a nosedive and you're going to lose all of your money if you don't get out of there soon enough. A company may or may not recover from an economic crisis. A perfect example is small businesses closing due to COVID closures. Some small businesses had to close for good. Some are on their last leg with indebtedness to their banks. Some are doing okay. Some are on the rise. It's all a matter of doing your research and, I guess, crossing your fingers that something doesn't terribly happen, especially within the next 10 years, especially after COVID. Okay, so this brings us to stocks and bonds. Are there any questions over anything so far? All right. So stocks are also known as shares in equity. They're a small portion of a company. They are riskier than bonds. They can fluctuate in price different than bonds. You can lose all of your money a lot quicker than with investing in bonds. Some stocks pay dividends. It's all based on the stage of the company and the financial health of the company. And there's capital appreciation and there's also capital depreciation. So capital appreciation is where the initial price that you bought it at increases. Capital depreciation is where it goes the other way and it decreases in value. It's not good. Bonds are fixed income. That's another name for bonds or debt instruments. They provide income over time at a fixed numerical value or a fixed percentage. That's why they're called fixed income. And it's usually debt that governments or corporations issue out to buyers. So here I want to give a little bit of a breakdown of a commonly traded stock. Microsoft, they are a technology company. They are, I believe, it's either the third or the fourth largest company in the S&P 500, if not it's either third or fourth. So this is a snapshot I took of the company from earlier today. And I took this snapshot from the website Yahoo Finance, and Yahoo Finance is free. It's completely free to everybody that you can just Google it. Definitely use this. Definitely, if you're interested in a company or if you heard a company in the news and you see how they're doing financially, go to Yahoo Finance, type in the name of the company, and what is it going to do? It's going to bring up the name of the company and a nice quote page like this. And you're going to have a couple of letters that are going to appear right next to the name of the company. So for Microsoft Corporation, it is MSFT. This is what is known as the ticker. The ticker is how a lot of traders, portfolio managers, finance professionals, investment advisors all around the world interact with different platforms. And instead of typing in Microsoft every time, they type in this ticker. This ticker represents this company. It's just an abbreviation, honestly. So Microsoft was extremely down today. You can see the prices for the last 5 days. They're taking a nosedive. If you look at the past year to date or the past year, they're doing really well. If you hit the max button, you can see the company's financial history all the way. I think it goes as far back as 1986, sorry. And I believe the company was trading for less than $1. So, if you invested, $1,000 into Microsoft, and you'd definitely be a millionaire by today. So it's always interesting seeing where a company started out and where they're at today. So I just wanted to give a couple tips and terminology lessons on what exactly we're seeing here. So this is the price you're seeing at the top of the quote. That's the price per share. So one share of Microsoft you can buy for around $200. And there's no limit on how high a price can go for a company. Amazon's is in, well above 3,000, I believe. So if you want to buy one share of Amazon, you have to shell out a couple $1,000s to buy one share. So, and it gives like a nice breakdown of the previous close price, the opening price, what time did the market open it at, what time did the market close it at for the next day, what's the days range, what's the 52-week range, where was it, what's the lowest point that it was at in a year. The volume right above the 52-week range, that is how many shares were bought and sold just that day. So for today, over 7.8 million shares of Microsoft were bought and sold throughout the day. And if you go to the second column in the quote next to the graph, there's something called a market cap. A market cap stands for market capitalization, and it is the overall worth of a company. So Microsoft is worth a bit over $1.5 trillion, which is an insane amount of money. And if you look down more to the bottom of the page, you then get what's called a dividend yield. So a dividend yield is the percentage next to the dividend. So Microsoft pays about $2.24 every quarter for every share that you hold. So that divided by the current price is going to give you 1.09%, which is going to be the dividend yield. So generally, if you want to look for companies that are going to give you large dividends over a certain amount of time, you want that percentage to be as high as possible. And a market cap, that number divided by the total amount of shares they have outstanding in the market, is what that price per share is representative of, if that makes sense. So we talked about stocks. How does a bond work? So here's an example. So say that Microsoft, the same company that we were looking at for stocks, let's say Microsoft issues a 5-year bond to raise money for themselves. So the par value here is going to be the principal. So the money Microsoft gets immediately by me buying a bond. So when Microsoft sells me a bond, I'm then giving Microsoft $1,000 for that bond. That's going to be the purchase price essentially. But the bond is often never the price of the bond. The par value, the principal, is often never the price of the bond, because bond prices fluctuate too. They can be above the par value, they can be below the par value. There's a whole bunch of math. There's entire books of thousands of pages out there just dedicated to how bonds work. So let's say the par value here is $1,000. So Microsoft wants to sell me a bond for 5 years. I then take $1,000 and I exchange it for that bond. So now I have a bond, but Microsoft now has $1,000 more than they did before I bought the bond. And they do this with hundreds of thousands of people and organizations yearly. So they can raise a lot of money this way at a cost, because the coupon rate, let's say, is 10%, and the frequency is 2. So they're going to give me semi-annual payments every 6 months. And these payments are going to be in the amount of $50, because the coupon rate multiplied by the par value is going to be $100. That divided by 2 is going to be 50. So every year, Microsoft is going to pay me $100 for holding that bond in the form of a coupon. So essentially, that's the interest.
I have a question.
Yeah, sure.
What's the difference between Jones and S&P?
Great question. So the Dow Jones Industrial Average is about 30 industrial-based companies. So it has been around a lot longer. And those companies are very safe. So they're not going to fluctuate in prices too much over the course of the next 10 years, except for a steady growth. The S&P 500 are more volatile stocks, so they move around a lot quicker when it comes to prices. So you could lose a lot more money, you could gain a lot more money than you would on average with the Dow Jones Industrial Average. So that's a great point. I actually forgot to bring this up, but the 3 most indicative American financial markets are the S&P 500, which is about 500 companies, the Dow Jones Industrial Average, which is about 30 companies that are primarily based on industrials, so shipping, factories, manufacturing, smelting, mining, very nitty-gritty jobs. And then you also have something called the NASDAQ, which is an index that covers all of the companies that are traded publicly on the New York Stock Exchange in New York City. So those, and that is, that index itself has a lot more technology companies than the other two. So they're even more volatile than the S&P 500 and the Dow Jones. Does that answer your question enough?
Yes. Thank you.
Yeah, no problem. Keep them coming. So as the bondholder, Microsoft will pay me $50 every 6 months for the next 5 years, just for holding that bond. If I don't sell it, I get that money. If I sell it, I get that portion of that principal back. I get the purchase price, but I lose out on those future coupons. So that's guaranteed money that's coming in every 6 months. You might think, $50, that's not nothing, for 6 months, for 5 years. I mean, but people who usually trade and sell bonds and invest in bonds, they're usually investing hundreds of thousands, if not millions. So that $50, if you buy enough $1,000 bonds, can quickly become $50,000, $500,000 every 6 months. It's all a matter about economies of scale. So it is true that you need money to make money, especially in the stock market. But we can also cover that too in the risk section. So let's say the 5 years pass, I get $500 in total for those 5 years. That last coupon payment at the end of the 5th year will also include the principal. So instead of getting $50, I'll get $1,050 because I'll get my money back. So when the bond matures in 5 years, I will now have $1,500 instead of $1,000. So you have to take it as you will. Is your $1,000 worth putting into a bond for the next 5 years to make it an additional $500? Is that worth it? Yes or no? It all depending on your preference, your financial status, your risk tolerance, and we can get to all that later as well. So what is a portfolio? So we talked about stocks and bonds and indexes. A portfolio is essentially just a combination of securities that you own. Securities are just investments. Yeah, think of securing your wealth. A person can have multiple portfolios. The most common form is a brokerage account. So a brokerage account is usually where you do the trading yourself, or you have an investment advisor do some investing for you and charging you a fee. Usually associated with having it underneath a broker dealer and having your own broker to broker stocks and bonds for you. Retirement accounts also are portfolios. When you open up a 401k, your money that you're putting in that 401k, that's being invested by a third-party company into the stock market for you. And that is going to match inflation and grow over time. Did you guys cover 401ks and retirement accounts and budgeting? If not, that's okay. So essentially, retirement accounts and 401ks are company-made plans, and you have the option of taking out a certain percentage of your paycheck every 2 weeks and putting that into a company-issued 401k plan for you. And over time, if you stay with that company, or even if you leave the company, you can get it rolled over into another account with another company. That money should grow, not just to beat out inflation, but also help you save up for expected cost of living adjustments, or vacationing, or any comfortable living levels that you want to have after you retire. So saving alone, I'm just going to say this right now, saving alone, putting money in a savings account is not going to cut it enough. You need to have a savings account should be your last resort. It should be your emergency fund, essentially. You should definitely, within the next 5 to 6 years, when you save up some more money, you should definitely think about opening up a brokerage account or putting some more money into a retirement account, because that growth alone off those securities will exponentially beat out any interest you gain on your savings accounts. So being financially healthy is meaning planning, 40, 50 years out. And that means starting to invest in your 20s. I can't stress this how important it is enough that you start investing before you turn 30, because that is going to take care of you so well in the future. Coming back to what a portfolio is. So portfolios can have various themes and different investment strategies. You can have a portfolio that's all bonds. You can have a portfolio that's all stocks. You could have a portfolio that's a mixture of the two. You could have a portfolio that's all managed account money, where you pay several different third-party investment advisors to manage your money for you. You still own the money, but you pay somebody else to invest it for you. A brief description of active versus passive investing. So putting your money into a fund that tracks the S&P 500 is passive. You put your money in, you look at it, you watch, you wait, and you don't touch it, and you let it grow. But if you're actively trading Microsoft shares, buying and selling throughout the months and years, that's active. That's active investing, and it's also referred to as trading. If you buy and sell securities within 1 year, it's called trading, and anything over a 1 year time horizon is called investing. All right, so I mentioned that brokerage accounts and retirement accounts are sometimes held by broker-dealers, but what exactly is a broker-dealer? So broker-dealers are also called BDs. They act as the middleman between retail and institutional investors. So when I say retail investors, I mean people like you and me who are planning for retirement, 50, 60, 70 years out, are saving up for a special event and you want to invest the money instead. Institutional investors are companies. So companies can invest too. Banks do it all the time. Companies all have finance teams, and they invest in other companies and banks and governments. And this is all how they generate revenue. It's anything to generate a buck, essentially. And so a broker-dealer acts as a middleman between those investor pools and the capital markets. The capital markets is just another term for the markets of different securities, financial products, vehicles, funds, all that good stuff. So some of you might have heard of Robinhood, Charles Schwab, and E-Trade. These are all really commonly known broker-dealers. So broker-dealer, the name itself, comes from two capacities that the firm operates in. So when a broker-dealer pairs up buyers and sellers of certain security, they are acting as a broker. But when they buy and sell securities for and from their own accounts, they are acting as a dealer. So think of Tinder. So Tinder is a platform that pairs up different people. You can think of a brokerage as the same way. They pair up different buyers and sellers, and they try and find the best price point between both of them for security, and they enact it. So they brokerage a deal, essentially. But sometimes a broker-dealer will buy securities from people that are selling it, or they'll sell securities to people who are buying it without finding another matchmaker on the other end. And when they do this, they are acting as a dealer, and they usually charge a markup on those securities. Whereas with a brokerage capacity, brokeraging a deal between buyers and sellers, sometimes they'll charge a commission if the trade is large enough. So if you make a trade for $2,000 or $3,000, they probably won't charge a commission on that. But if you're making a large trade for $40,000, yeah, they probably will charge $10, $20 for that, such a large transaction. And I do know that Robinhood and E-Trade, they do have commission-free trading on most of their securities. But of course, you always should, even before you open up a broker-dealer account, you should definitely do research on the broker-dealer. You should definitely read reviews, the pros and the cons, what people like, what people don't like. And the internet is full of critical reviews of broker-dealers. So.
How was it, Carl?
How was what?
I have a question. Or am I
Yeah.
supposed to wait until the end?
Sure. No, you can go, Ricab.
Okay, my question is, when a college student like myself starts investing, should they have a portfolio? And if so, where should they start? Like other than apps like Robinhood.
Right. So I'm not an investment advisor, so take this with a grain of salt, and this is full disclosure. I do believe that, we are in like a state where if we were starting to invest, it wouldn't make too much of a difference. But if you save up some money and you do make the decision to start investing, whether it's this year or like your first year in a career role, or even like 3 years in a career role, I would definitely start off small, but grow it. And sometimes what a broker dealer has is they will have pre-built portfolios that they offer on shelf. So a personal example is I have a brokerage account with E-Trade. And what E-Trade has is they have pre-built mutual fund portfolios and ETF portfolios. So what I did was I took a look at some of their pre-built ETF portfolios, and I set up about $2,500, and I bought it. And what it automatically did is that brokerage took that money and they divvied it up between some of their most popular ETFs that they have on shelf that they recommend for their clients. And they automatically allocated it to a certain grouping of ETFs. So I would definitely say start off simple with different funds rather than going straight into some of the more popular companies. Because if you start off with an ETF, and an ETF is an abbreviation for an exchange traded fund, what you're doing is you're buying an underlying basket of securities. So you can be buying fractional shares or a small, very small portion of one share of, up to, 700, 800, 900 different companies all within one basket. So you own very, very, very little of one share of each of those companies, but when they do well, the ETF does well and you do well. And so I would definitely look up different ETFs, and afterwards, if you guys are interested, I can make you a list of what the investment group has been looking at in terms of stock pitches, and as well as some of the more popular ETFs out there, some of the more safer ETFs. So I would definitely recommend getting a portfolio, Gab, within, I'd say, probably the next 1 to 3 years, or at least starting off small. You can start off small and just like grow it. You could put money in every month. Some advice I got when I was working in my internship 2 years ago was my boss told me sometimes it's helpful to put in $20 every week into the stock market, even if you don't invest it, and put it into like a cash account and just put it in there. You will be tempted to invest it, and even if you sell it at a loss, that's part of the learning process. And every time you take a loss, you learn a little bit of something about a company or about an industry or about investing in general that makes you a better investor in the long run. So certainly taking losses this early in life is a good thing. If you fall off the horse, you just get right back up. Same philosophy can apply with investments. So I definitely recommend getting a portfolio that is more on the safe side. And sometimes you can also contact a broker dealer themselves and ask, to you, what is a safe asset? Where is a good place for me to start? And they're very helpful too. Does that answer your question, Gab? But I probably threw information at you.
That was great. No, thank you so much.
Yeah, no problem. So this is my last slide of information. So some of the common risks that are associated with investing. So every dollar you put into the market benefits the economy in some way. However, and this is a ginormous however, it also opens that dollar up to risk. Like I said before, nobody can travel through time. Nobody can tell the future. Nobody knows where the state of the stock market is going to be in 5 years or 10 years. There's a good chance that it's going to be positive and that your money will be growing, but it's not a guarantee. So just knowing that and keeping that in the back of your head and always being cautious, and you always want to do your research, and you never want to invest with emotion. That's like one of the biggest factors in people losing money is they get excited or they get scared about current prices or a news article or what everybody else is doing, and they might sell something early or buy something late and they lose out on money from it. So definitely keeping your emotions in check is a great way to start investing. And volatility. So volatility just means large fluctuations in prices. It refers to risk. So if a company is, this sounds a little silly, but so I'm gonna draw with my line. So if you have a company that's like steadily growing over time, it's gonna have low volatility versus like a company that's like going up and down, up and down, up and down. That looks like a heart rate monitor. You definitely don't want that. So definitely pay attention to a company and how volatile it has been in like the past couple of days, past couple of months, past year. And also with that, you should also pay attention to the fact that historical performances are never a good indication of where a company is going to be. Just because a company has been doing well doesn't mean it's going to continue to be doing good. Just because a company has been doing really bad doesn't mean that they're going to bounce back within the next year. It's all about the financial health of the company, how it's being run, the market it's in, the industry it's in, and the general state of the economy. Great examples of volatility in, we had the election on Tuesday. Markets have been down a lot this week. A lot of people have lost a lot of money because a lot of people are pulling out early from the markets. A lot of people are selling off their stocks and bonds because they are afraid that, if a certain candidate gets elected over another candidate, then the stock market's going to go down even more and they're going to lose even more money. So elections have always been a cause of volatility in the markets. It's not just this election. It's been every single election since the stock market has opened up. And obviously, COVID causes companies to close shop. It decreases revenues, which decreases the performance, which decreases dividend payouts. So I definitely would say on a safer side, right now is probably not the best time to start investing, just because there's so many additional factors that will cause volatility. And I would definitely say if you are thinking about investing right now, it might be better to wait a little bit. But I'm not an investment advisor, so don't take everything I say word to word. And I'm going to open this up for any questions that you guys might have.
I got a question. Can you hear me?
I can, yes.
Okay. So, when you start looking to, what is it called? What's a brokerage accounts? How do you look into that? Do you just type in brokerage accounts, or is there specific ones you would recommend for a person that's starting out?
For starting out, you definitely want like a healthy user interface that is friendly to people who have not been investing at all. So when it comes to that, Robinhood has a very easy to understand user interface, but they also make it very easy for you to invest. It looks very fun. Sometimes it looks like a video game. A lot of people lose money just because they like the visuals on Robinhood. So Robinhood is an interesting brokerage in itself, and definitely be careful of that brokerage too, because they have had some coding issues in the past that has caused people to lose money as well. I personally use E-Trade because I find it easy to use, informative, and helpful. And also if you have a bank that you use, most banks have a financial advisory department. So what bank do you use? Just curious.
Wells Fargo.
All right, so Wells Fargo definitely has financial advisors. But a lot of them sometimes will have a minimum that you have to invest with them in order to invest. So some broker dealers, it's 50,000. Some broker dealers, it's 100,000. Fisher Investments, I know, is $500,000. For them to even look at you and take your money and invest it for you. So Charles Schwab is pretty reliable. So I would definitely Google Charles Schwab and do some research on that brokerage, broker-dealer. E-Trade, do research on E-Trade, do research on Robinhood. Fidelity Investments is another respectable firm. I'm trying to think of others. Honestly, if you just type in top 10 brokerage firms in the US, it'll bring up a list.
Okay, thanks.
You're welcome. I know I confused somebody in the group about all my information I threw out. So I definitely know there's at least 1 or 2 more questions that you guys have for me. No questions too small. All right, I guess I'm gonna have to pick on somebody. Hey, Amato, I know you have a question for me.
Matu just went out, stepped out real quick.
Classic.
She's
Okay, so if you guys don't have any questions for me right now, I am available by email, or if you guys want to meet up and hear me yammer on more, I can do that as well. I have a pretty busy schedule, but I will make time if you guys want it. So on that note, let me stop sharing my screen. Okay. All right, so